A question I get often from business owners is whether or not the car should be under their name or their business name. And how can they write off their vehicle as a business expense if it's under their personal name? All right, so the law states in order for us to deduct a business vehicle, the vehicle must be ordinary and necessary for the business owner in nature, and that must be used for more than 50% for business purpose. With that said, yes, you have to have documentation for these expenses in the event of an IRS audit. You should have proof that you're using it for business purposes. The easiest way is to track your miles. Now, there are two ways that you can deduct the vehicle expense. Either you choose to use the standard mileage rate or the actual expense. What's the difference? Standard mileage rate is just that, calculating the amount of business miles commuted by the standard rate, which for tax year 2023, it would be 65.5 cents. So if you drove 10,000 business miles at 65.5 cents, that'll be 6,550 tax deduction. Simple. Now, actual expense method. You'd have to determine what it actually costs to operate the vehicle for the portion of the car used for business purposes. So let's say you drove the car for a 75% used for business. You take note of the business expenses needed to operate, whether it's car payments, gas, oil, insurance, registration, and you would take 75% of those expenses and deduct it as a business expense. All right, those are the two methods of writing off the vehicle. Now let's talk about depreciation. Standard depreciation, no special method or strategy. Car depreciation is the rate at which your vehicle loses its value over time. A car is fully depreciated over 5 years. It doesn't matter if it's 2,000 pounds or 7,000 pounds. So let's say you purchase a $60,000 car. You can write out $12,000 a year for 5 years. So by the 5th year, the car would be fully depreciated. Have more questions? Contact us through our website, mytrustedtaxadvisor.com.